Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 15th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is finally evidence of accelerated shelter disinflation amid fresh evidence of our resilient U.S. economy theme. So the nuance there is that the April retail sales data supported our resilient U.S. economy theme. The April CPI report was supportive of our sticky inflation theme from a levels perspective, but unsupportive from a delta perspective. Yesterday, Fed Chair Jerome Powell reiterated his desire to be patient and let restrictive policy work at the Dutch Foreign Bankers Association event, underscoring the asymmetric reaction function he codified at the May 1st FOMC. All right, in terms of market implications, so with respect to inflation, the delta is what matters most for now, given the Fed's asymmetric reaction function and the fact that we are finally starting to see evidence of accelerated shelter. Let me start. 3, 2, 1. So in terms of market implications, with respect to inflation, the delta is what matters most for now, given the Fed's asymmetric reaction function and the fact that we are finally starting to see evidence of accelerated disinflation in reported shelter inflation. Specifically, slowing inflation should cause investors to price incremental dovishness into the forward rate curve. In isolation, that dynamic is bullish for asset markets until our resilient U.S. economy theme is no longer active. All told, every investor now understands that incrementally adverse inflation data will only delay policy rate easing, which is supportive for asset markets until concerns about stagflation become dominant. Transitioning to our 42 macro dashboard here, as always, wrapping up with the question from our community. This one's regarding quantifying the quarterly refunding announcement and balance sheet runoff net effects. So it says, hi, Darius, great macro scouting report. As always, I look forward to it each month, and it never disappoints. Now that Jay and Janet are no longer in cahoots, I'm wondering if there is a way to quantify the net impact on U.S. liquidity from their divergent policy plans. I was thinking of the general framework below, but wanted to get your thoughts on whether these metrics are comparable on an apples-to-apples basis. So the question goes on to highlight this investor's framework for trying to quantify the net effects of changes in the quarterly funding and changes in the Fed's balance sheet program. Without getting into the nitty-gritty of it, the key takeaway in terms of the answers there is that we don't think it's appropriate to net those signaling components out. Specifically, if you think about the quarterly refunding announcement and the changes in composition of the Fed's net financing, those changes in the composition of net financing and the aggregate sum of net financing almost always overwhelm the Fed's policy prescriptions in terms of the balance sheet program. Specifically, if you think about this from a next 12-month financing perspective, in terms of the total amount of Treasury supply maturing over the next 12 months that needs to be refinanced, the likely size of the budget deficit, and then when you layer on the Fed's impact on that from a balance sheet runoff perspective, the total amount of marketable Treasury debt supply that's going to hit the market on a net basis over the next 12 months is somewhere around $10.4 trillion. $10.4 trillion. So obviously, when you consider the changes in the Fed's balance sheet are really kind of a drop in the bucket in the context of that large sum. So in our opinion, it doesn't really make sense to try to net those out. In our opinion, what really matters from the perspective of the Fed is their signaling with respect to the direction of monetary policy. When they are easing monetary policy, all things being equal, it makes the value of bonds go up, value of coupons, so notes and bonds go up, the interest rate declines, and it makes investors want to hold those assets at the margins. And that is the most important takeaway you should get from the Fed. It's not necessarily trying to quantify the specific dollar amount, but also what they're signaling, how their signaling impacts the forward rate curve and the investor demand for those particular assets. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, May 15th, 2024. Everyone have a wonderful day out there. Best of luck, and we will catch you back here tomorrow. Cheers.